Welcome to Burns Hustles, where we turn side hustles into cash. Who is the man behind the investment strategies of Warren Buffett? To understand this, let's travel back in time to the early life of Benjamin Graham. Born in London in the late 19th century, Graham's life took a dramatic turn when his family relocated to New York City. The city, bustling and full of opportunities, became a backdrop to his formative years. However, life wasn't always kind. At a tender age, Graham lost his father, which plunged his family into financial struggles. Despite the hardships, Graham was an extraordinary young man. He was academically brilliant, showcasing an intellect that far exceeded his years. His academic prowess didn't go unnoticed. He graduated as the salutatorian of his class from Columbia University, a testament to his remarkable intellect. Graham's early life was a blend of trials and triumphs. It was a crucible that forged his character and resilience. Despite the hardships, Graham's early life experiences shaped his character, leading him to become one of the greatest investment minds of the 20th century. Graham's approach to investing was both innovative and effective, a philosophy that would later be adopted by successful investors like Warren Buffett. At the heart of Graham's investment philosophy lied a few key principles. Let's break them down. First up is the concept of Mr. Market. Picture this. You have a business partner named Mr. Market. Every day he offers to either buy your share of the business or sell his share to you at a specific price. Now Mr. Market, he's an emotional fellow. Some days he's overly optimistic and quotes a high price. Other days he's pessimistic and offers a low price. The key here is that you are not obliged to agree with Mr. Market. You can choose to ignore him until he quotes a price that you believe is fair. This analogy, coined by Graham, emphasizes the irrationality of the stock market and encourages investors to not be swayed by market fluctuations. Next is the margin of safety. This is a principle that urges investors to only buy stocks when they are priced significantly below their intrinsic value. By doing so, investors are safeguarding themselves against uncertainties or errors in their analysis. The larger the margin of safety, the greater the room for error in your judgment and the higher your potential return. Think of it as a buffer, a cushion against the unexpected. Finally, the core of Graham's philosophy: value investing. This is the practice of buying stocks for less than their intrinsic value. It's about finding those hidden gems in the rough, those undervalued stocks that have been overlooked by the majority. Graham believed that the market often mispriced stocks, which created opportunities for value investors to buy high-quality stocks at discounted prices. So, how does one determine a stock's intrinsic value? Graham advised investors to focus on a company's fundamentals such as earnings, dividends, and assets. He believed that over time, the market would recognize and correct any mispricing, and the stock's price would eventually reflect its true value. Now, it's important to note that Graham's philosophy is not a get-rich-quick scheme. It requires patience, discipline, and a willingness to go against the crowd. It's a marathon, not a sprint. Graham's investment philosophy is also about maintaining a level-headed approach to investing. It's about not letting emotions cloud your judgment, not getting caught up in the hype and speculation, and always sticking to your principles. To sum it up, Graham's philosophy was not about making quick money. It was about making informed decisions, minimizing risk, and ensuring long-term success. The principles of Mr. Market, the margin of safety, and value investing are timeless strategies that have been proven to work time and time again. They remind us that investing is not just about numbers and charts, but also about patience, discipline, and a deep understanding of a company's worth. Graham's investment philosophy was not about making quick money. It was about making informed decisions, minimizing risk, and ensuring long-term success. Graham's investment philosophy was encapsulated in his seminal work, The Intelligent Investor. This book, published in 1949, shook the foundations of the financial world and introduced a revolutionary perspective on investing. In The Intelligent Investor, Graham emphasized the importance of analyzing the intrinsic value of a company rather than its market price, a concept that was truly novel at the time. He proposed that an intelligent investor should focus on the fundamentals of a company, such as its earnings, dividends, and assets, instead of getting swept up in market trends and hype. Graham introduced the concept of Mr. Market, a fictional character representing the stock market's irrational behavior. He used this character to illustrate that the market could be irrational and volatile, often driven by emotions rather than logic. Understanding this, Graham argued, was key to becoming a successful investor. The Intelligent Investor also introduced the idea of a margin of safety, which meant purchasing stocks at prices significantly below their calculated intrinsic value to allow for unforeseen adverse events. This principle aimed to minimize potential downside risks while maximizing investment returns. These groundbreaking ideas transformed the world of investing. They offered a new way of thinking that allowed investors to make more informed and rational decisions, thereby reducing risk and increasing potential returns. The intelligent investor has had a profound impact on many successful investors. One of its most famous disciples is Warren Buffett, arguably the most successful investor of our time. Buffett has frequently credited Graham's teachings, particularly those in The Intelligent Investor, as the foundation of his own investment philosophy. The principles outlined in The Intelligent Investor have stood the test of time. Even today, more than 70 years after its publication, it continues to be a highly regarded resource for investors around the world. Its enduring popularity is a testament to the timeless relevance of Graham's investment philosophy. The Intelligent Investor remains a must-read for anyone interested in understanding the principles of value investing. So, how did Graham make money following his own investment philosophy, you might ask? Well, it all boils down to a couple of key strategies. First and foremost, Graham was an advocate for buying undervalued stocks. Now, when we say undervalued, we mean stocks that were priced significantly lower than their intrinsic value. Graham believed that the stock market often mispriced companies, either out of ignorance or emotional responses to short-term events. This provided savvy investors with an opportunity to buy these stocks at a discount and reap the profits when the market eventually corrected itself. But how did Graham identify these undervalued stocks? He used a method called fundamental analysis. In simple terms, this involves scrutinizing a company's financials, looking at its assets, earnings, dividends, and financial structure, among other things. By doing this, he estimated what he thought the company was truly worth. If the market price was significantly lower than his estimate, he saw it as a potential investment. However, it wasn't just about identifying and buying undervalued stocks. Patience played a crucial role in Graham's strategy too. He was not interested in making quick money. Instead, he was a long-term investor, holding on to his investments for several years, sometimes even decades. He understood that the market could take a long time to recognize a stock's true value, and he was prepared to wait. And it wasn't just about buying and holding either. Graham was an advocate for diversification. He believed that spreading investments across a wide range of stocks could reduce risk and increase the chances of overall success. So, Graham's strategy was a blend of careful analysis, patience, and diversification. He was not swayed by market trends or short-term events. Instead, he focused on the fundamentals, trusted his analysis, and waited for the market to catch up. And catch up, it did. Time and again, the market eventually recognized the true worth of Graham's investments, leading to substantial profits. Graham's success wasn't about timing the market, but time in the market. He demonstrated that with careful analysis, patience, and a long-term perspective, anyone can achieve success in the stock market. The legacy of Benjamin Graham extends beyond his own success. In the world of finance and investments, Benjamin Graham's influence is undeniable. He was not just successful in his own right, he also deeply impacted those who followed his path. Particularly, a certain someone by the name of Warren Buffett. Yes, that's right, the Oracle of Omaha himself was a student of Graham. Buffett once said, "I'm no genius, I'm smart in spots, but I stay around those spots." One of those bright spots was surely the time he spent learning from Graham. Buffett was not just a pupil, but a passionate disciple of Graham's philosophy. He absorbed Graham's teachings and went on to become one of the most successful investors of all time. But more than that, Buffett carried forward Graham's legacy, his principles of value investing, his emphasis on rigorous analysis, and his commitment to discipline and patience. But it wasn't just Buffett. Graham's influence has permeated the world of investing. His contributions to the field of financial analysis and investment are immense. He essentially wrote the playbook for value investing, and his book, The Intelligent Investor, is often referred to as the Bible of investing. His principles and methodologies have been adopted and adapted by countless investors across the globe. Graham's legacy is not just about the money he made or the successful investors he trained. It's about the way he changed the face of investing. He turned it into a discipline, a science, something that could be studied, analyzed, and understood. He gave us the tools to make intelligent investment decisions, to look beyond the hype and speculation, and to focus on the intrinsic value of a company. And that's the true power of his legacy. Yes, he was a successful investor. Yes, he trained some of the best minds in the field. But more than anything, he gave us a framework, a philosophy, a way to approach investing that stands the test of time. Benjamin Graham's philosophy, lessons, and strategies continue to guide investors today, proving that the principles of intelligent investing are indeed timeless.